It's that time of year again, when we close the books on one year and look ahead to the next. For investors, that means navigating a market environment that feels both encouraging and uncertain. As is often the case, there are real reasons for optimism, but also risks that deserve attention. Today, I want to walk through 3 things we believe could be positive for investors heading into 2026, and 3 risks we think shouldn't be ignored. The goal here isn't to make predictions, but to frame what we believe are some of the bigger market-moving issues for the coming year. Let's start with the positives. First, monetary policy. Unlike this time last year, financial conditions are much more market-friendly. The Fed has already eased several times, and there are expectations for additional future cuts. Because policy works with a lag, those initial cuts are only now beginning to support growth. Rather than a headwind, monetary policy looks likely to be neutral or even a tailwind in 2026. Second, AI-related capital spending. The US remains a consumer-led economy, but CapEx tied to AI has become an increasingly important growth driver. Spending on data centers, chip capacity, and power infrastructure is expected to continue growing and supporting economic activity. Third, fewer policy surprises. New administrations always bring policy shifts, and 2025 certainly had its share, especially around tariffs. While tariffs aren't expected to disappear, investors and economists have now had plenty of time to digest a wide range of outcomes, meaning the largest market impacts are likely behind us. Now for the concerns. Valuations remain at the top of our list. There are still pockets of opportunity, but they're becoming harder and harder to find, and few assets could be described as cheap. Stocks we describe as on the wrong side of average, while bonds look closer to fair, meaning they aren't expensive, but they also aren't particularly a bargain either. As a quick reminder, valuations are a useful guide for long-term returns, but they're not a timing tool. So elevated levels alone don't signal anything imminent. Inflation is another risk. While inflation levels and pressures are well below the peak from a few years ago, they haven't fully disappeared. As this graph in history shows, inflation can also sometimes re-accelerate. While that's a lower probability outcome, it would be meaningful if it did occur. Finally, the labor market. Because the US is a consumer-driven economy, employment trends matter. We're not seeing widespread layoffs and incomes are still rising, but the labor market has certainly softened, with the unemployment rate up about a percentage point year over year. There are reasons for optimism, but the recent trend bears watching. Keeping these types of lists to just 3 items obviously leaves plenty out, but we do believe it helps focus on some of the most relevant themes as we head into the new year. Lists like these are also short-term oriented, and we happen to be long-term investors. So our core message doesn't change. Stay focused on long-term goals, remain disciplined, and stay diversified. On that note, I hope you'll join me for our next video, where I'll discuss a mistake we think many investors are making today when it comes to their equity portfolios and diversification.